Hello to all the debt warriors listening, and welcome back to another episode of Millennial Debt Domination. I'm your host, Katie Fata. An interest rate is the percentage rate that your lender charges for you to borrow money. The current average mortgage interest rate is 6.5 to 7%. This high interest rate is making it extremely difficult for younger millennials to purchase a home. High interest rates mixed with low income, student loans, and other debts are pushing the goal of homeownership out of reach for millennials. Today, I'll be joined by Grant Gallagher. Grant, a millennial himself, is the head of financial well-being and brand communications at Affinity Federal Credit Union. He's also the co-host of Affinity Federal Credit Union's podcast, Wellbeing and Your Wallet, that you can find on all major podcasting platforms. Grant and I will be discussing rising interest rates, reasons keeping millennials from becoming homeowners, the impact COVID-19 has had on homeownership, and much more. Now let's get to my interview with Grant. Hi, Grant. Thanks for being on the podcast today.
Thanks for having me, Katie.
I'm looking forward to talking to you and not only talking about the current housing interest rates and how they're affecting millennials, but also we can talk a little bit about Affinity Federal Credit Union. Let's talk about your goals for helping your members achieve financial wellness before we get started with the topic.
Okay, great. Yeah, happy to. Again, thanks for having me on the podcast. I think from coming from a credit union background, this is definitely a topic that we try to help our members with every day. So, for those of your listeners that are not familiar with what a credit union is, it's a not-for-profit member-owned financial cooperative. So, all of the people who come to us who are, typically customers at a bank, they're our members instead, and they're all partial owners of the organization. So we, our goal is to enhance their financial lives. And, one of our focuses as an organization is member well-being. And what that means is, most people look at their finances from a very technical mathematic standpoint, but realistically, we're emotional human beings. We look everything through an emotional perspective. So why should your finances be any different? So, especially when you're creating those financial dreams, they come from an emotional place. So our approach is to talk to our members, understand who our members are, what's important to them, what makes them tick, and help them create realistic goals and plans that align with what matter to them. Really, we want to align with their goals and help them achieve their financial well-being. And, from the more technical side of things, we're a full service credit union. So we have branches in New York, New Jersey, and Connecticut, with most of our branches located in New Jersey.
For our listeners, I will link Affinity Federal Credit Union in the description of this podcast so everyone can get that there. So let's kind of get into our topic. There has been a lot of focus recently on the housing market, which has been complicated by rising interest rates. This is making it difficult for first-time home buyers to break into the real estate market. Are you seeing that with your members?
Yeah, this has been a hot topic for actually not just a single year, but a couple of years now. Mm-hmm. One of the challenges that we do face, and that's part of the reason why I did share our geographic location is our members are in a higher cost of living area. So, right off the bat, that's kind of an upstream effect that people are already facing. They're already facing higher costs. Yes, you do typically see a little bit of a higher income in those areas too, but New Jersey specifically is pretty well renowned for its high taxes as well as its high cost of living. So it's a double whammy there.
Yeah, I'm in New Jersey, so I 100% get it.
Yes. So yes, our members are seeing this firsthand. They have for a while, and it's tough because with the way that things have changed, there's a whole slew of factors that have made it even more difficult. The interest rate environment's made it more difficult because people don't want to lose that good interest rate mortgage that they had. We were already seeing a challenging market where there was lack of inventory before those rates started going up. Housing values have climbed. So it's like, if you're looking to buy right now, there's a lot of headwinds pushing up against you.
And then in addition to all that, you also need a down payment to jump into the
Yes.
housing market. So what percentage of a property value is required for a down payment, and how has that changed over the last 10 years or so?
So the answer is it depends. The big main golden number that we like to put out there is 20%. And that's really the threshold in which you can avoid private mortgage insurance, which is typically referred to as PMI. And, PMI is basically an additional surcharge on top of your regular interest, insurance, your mortgage payment, to basically ensure the lender that they're going to get their payment. So it's a double-edged sword where it enables borrowers who don't have 20% to put down as so they're able to get a mortgage even with that lesser down payment, but it does add an additional amount to your monthly payment, sometimes between 10 and 20%, depending on how qualified of a borrower you are. So obviously a mortgage is going to be an expensive proposition in the first place. And then adding PMI on top of that can make it even more so, but realistically, if buying a home is important to you and you just don't have the ability to put down that 20%, there are ways that you can put down as low as 3% in some instances. And then you can have that PMI removed once you've reached 20% equity. So that is a valid strategy for a lot of people. But there are many people that I've talked to that just hate with a passion paying PMI because they just see it as a additional fee.
Yeah, that makes sense. And then let's talk about an individual's income, especially millennials. And how does an individual's income impact the ability of millennials to purchase a home? Do you think there is a disparity between income increases and the rise in housing prices?
100%. We've, over the past few years, there has been some nice income growth, which is nice to see. It definitely isn't something that occurs all too frequently, but we've also seen that rise in housing prices. The housing market, the pricing there just continues to rise and rise and rise. I will say that we have seen that kind of taper off a little bit, but the rise in housing prices definitely outpaced income growth. So definitely a challenge for anybody who's either early in their career or even, not fully established in their career. It is a tough market out there.
Yeah. And I know we were just touched on this tri-state area where it's very expensive in New Jersey, New York, and Connecticut, where your members are. So let's kind of move on to maybe middle America. So what is the average income needed to afford a mortgage in middle America now, kind of versus where we are?
Yeah, no, that's a great question. And it's really important because real estate is so highly location dependent, right?
Yeah.
Affordability is subjective. If you, are somebody who can manage to get a remote job, that's in one of these high cost of living areas and then live in a low cost of living area, you're really living that dream. But, prices are pretty much up there across the board. And, what happens is a lot of people struggle to figure out what they really can afford and don't get expert opinions and kind of dive in head first, and they wind up house poor, and that's when you have that home, but you're, sitting in the dark on a cardboard box eating ramen noodles because you can't afford to put food on the table. You can't afford the furniture, and you're struggling to pay the electric bill. But really, when we're looking at it from an actual dollars and cents perspective, I looked at some rates from Go Banking rates, and when you're looking at middle America and actually the majority of the country, you need about $80,000 to afford your average home. Now, when you're going into more coastal areas, moving out from the center, we're talking about your Arizona, Connecticut, Florida, Maryland, Montana, Nevada. That's all more in the $100,000 range. And then when you're looking at those high cost living areas, we're talking about your New Jerseys, New Yorks, Washington, California, Alaska. And believe it or not, Alaska's in that high cost of living area
Mhm.
bucket for some reason. I'm imagining everything's just, has to be shipped out there. So it's more
Right.
expensive to live. But then you're looking at over $100,000,
Yeah.
and that's really just to afford the mortgage.
Mhm.
Realistically, if you want to be comfortable, being able to maybe save a little money, maybe being able to go out to eat once in a
Right.
while, a crazy concept, you're probably looking at more like $115,000.
Right.
So that's a pretty big jump, especially when I believe there was some recent statistic out there where it classified middle class as earning $75,000.
Right.
So that's a pretty big disparity between what you realistically need and what people think of as middle class.
Especially as a millennial too, trying to, if
Yeah.
especially as a single millennial, it
Yes.
seems impossible almost. So that's definitely why it's harder on millennials to buy houses. And on top of that, there's interest rates. So let's talk about interest rates. What is
Yeah.
the current average mortgage interest rate, and how does this rate affect the housing market?
So, I do have to come in and do note that, my compliance area would not be thrilled if I was quoting specific rates. So I'm going to give you some ranges here,
Okay.
and caveat of they are constantly changing.
Yes.
But if you look at it from an overall average perspective, we're looking at about 6.5 to 7% right now. And that's actually come down a bit. When we're looking at around October of 2023, that's where those rates kind of peaked at around 8%. And then they've really started to trickle down a little bit since then. Believe it or not, rates right now are about where they were about a year ago, but back then they were trending up and now we're kind of trending down. So hopefully it continues in that direction, and it's going to result in better inventory out there. It's going to make it,
Right.
mortgages more affordable in general, but you got to have a crystal ball to really make any
Yeah.
definitive judgments.
That's kind of what
there.
I was going to ask you next. If you think interest rates will ever return low, like as low as maybe like 3% again. It's hard to tell.
It's entirely possible,
Yeah.
but it needs to have a recession for that to occur. I mean, that's basically it. There needs to be some sort of pressure to really need stimulation to the economy. We need to have, the Fed dropping those rates down. I mean, when we were at that 3% range, I mean, the Fed had rates at basically, near 0%, record low amounts. So that's basically where we need to see that again. Nobody really wants to live through what you get to that point to see that, but it is a silver lining if you're looking to buy a house and you're not impacted otherwise. Realistically, we're probably just going to see them taper down a little bit more as the Fed does change rates, but we'll have to see.
So earlier we touched on how there's a low inventory right now in the housing market. So do you think that people are less willing to sell their homes that have existing low rate mortgages to start again with a new higher interest rate mortgage?
100%. I mean, it's the reality is somebody that got a mortgage at 2.5, 3, 4%. If you were to get that same mortgage today, they'd be paying basically double amount of interest. I mean, it can make a affordable mortgage into an unaffordable proposition. So people are very hesitant to move and kind of start that mortgage over at a much worse rate. But the other thing is that's not the only factor that's impacting low inventory. People have been moving a lot in the last few years just to changes in lifestyle, changes in expectations, changes in priorities in their life. And, one of the things that we've historically seen a lot of, which is people that are getting into retirement and moving, downsizing, things like that, that's been happening at a much slower rate than I think anybody has anticipated, with the baby boomer generation staying in those larger houses for longer instead of downsizing. So there's a lot of different things at play here, and it's all kind of netting out to that lower inventory environment.
Yeah, and I also think it's like the baby boomers aren't retiring as young as
that too.
They're still working super late. They're working into their 70s even. And at that point, they might just be like, why do I need to move now?
Yeah.
So that's happening a lot.
And the unfortunate piece is that, some of them can't afford to retire. Some of them, don't have that solid retirement plan. And, now it's working to live. That's what they have
Yeah.
to do.
Yes. And that's always kind of why on the podcast and everything tell millennials to start investing in their retirement now.
Yes.
So then they're kind of set for when they are older. So what are some moves millennials can make to aid them in purchasing a home?
So there's actually a couple of things that my wife and I considered when we were buying our current home.
Mm-hmm.
And the first one, which is kind of becoming more challenging, but it's buying a fixer upper. That's one of the ones where it's you're finding an older property, but as home renovation shows have become more popular, people swooping in to buy those properties, fixing them up and flipping them has become much more common. But if you can find that fixer upper and you are a patient person and willing to live through renovations, great way to have a significant have a place to live, but also have a significant return on your investment. Then you really are looking at it as an investment. The next is kind of managing your expectations. Do you really need to have a house with 3 or 4 bedrooms? Do you need to have a big yard? Do you have to have, what are the things that you truly do need? Because everything you add to that's going to increase the price. Realistically, every bathroom you add on there, it's nice to have, but it's going to increase your cost. And bigger the property in general, it's nice to have a backyard to, have the dog run around in, but it's going to increase your cost. So think about what amenities, what things are your critical pieces in that home you're looking for, and, cut them out. And you can probably find something that falls into your bucket that's a little bit cheaper, a little bit more affordable. And, listen, it's a tough time right now, but think about it as a timeline. Are you going to live in that house for a few years? Are you going to live in it for 5 years? Are you going to live in it for 10 years? Can it meet your needs in that time? And then you can always move. There's the concept out there of that starter home, bare basic things that you need. And then you can always move when the environment gets better, when you truly do need more space. It's not people kind of seem to think of it as like, well, I'm making this huge move. It's going to be forever. It's not going to be forever. You can always, move and change as things progress in your life. For most people, this is, the poorest they're ever going to be. In theory, they're going to continue to grow their income, grow their wealth, grow their savings, and be in a better place in a few years.
Especially for millennials too. I mean,
Yes.
there's a low chance that the home you're going to buy as a millennial is the home you're going to stay in forever. So, and also when you said, sometimes it makes me think about when people buy houses, location versus a large home. Would you rather have a large home and be far away from everything, or a smaller home and kind of closer to everything? You have to weigh out those costs too, which is something I always think about.
That's totally true. I mean, if you're willing to move out to the country, there's typically houses you can get for twice the size for for the same amount as what you're getting in a more suburban urban area. But you're going to be really far away from stuff. It's going to be a longer commute. Are you going to have a network of friends and family nearby that you can tap into? So, it's all a balance of kind of cost and expectation. But, maybe you meet somewhere in the middle and you just move 20 minutes further out from the area than you were looking for. And that does make things more affordable.
What are some reasons other than rising interest rates keeping millennials from becoming homeowners?
Well, there is always everybody's, favorite topic of conversation, student loans and debt surrounding there. That's definitely been a hot topic with the federal student loan forbearance kicking back in or ending, and people having to pay their loans again, and not necessarily having saved or expecting that. But I mean, the other things too. I mean, debt in general is a huge challenge for a lot of young people, where it's maybe they didn't understand how to manage a credit card when they were younger, and they're carrying, $10,000 in credit card debt and trying to figure out how to do that. Vehicles and vehicle loans have become significantly more expensive in the last few years. I was seeing a statistic where the average auto loan 3 years ago was around $200 to $300. Now it's $500. All of these things are adding up. And, not to point to everybody's favorite scapegoat, inflation, but, everybody's talking about how inflation is slowing down, which is great, but it's not deflation. So those higher prices are here to stay until something else changes and pushes the pressure on those prices to go down. So if you're making the same amount of money you were 2 to 3 years ago, prices are still 20% higher across the board, even if they're not still creeping up. That's a huge challenge that you're facing. And the other piece, I am a father of two wonderful toddlers. They're twins, and their daycare tuition is more than my mortgage.
Oh gosh, yes.
So yes. So if you have little ones that need childcare, it is going to be a massive, massive challenge. That is my biggest bill.
And a lot of millennials maybe aren't even having kids for that reason. And that might also
Yeah.
just be them pushing off having a house because they're just, why do I need a house when I can't even afford kids. So
If somebody told me how expensive daycare was before I had kids, I might have taken a second thought there.
Yeah. Yeah, I mean, I'm almost 30 and most of my friends do not even have children or houses. So it's definitely rough.
Yeah.
So
Yeah. Do your research before you have kids.
yeah. Did COVID-19 impact homeownership plans for millennial? Let's start talking about that.
Yeah, I mean, I would definitely say yes. I want to say that one of the things that we saw was there was a big shift, and granted, now we're looking back from 3 years out, but a lot of people kind of changed their plans, changed their expectations, rethought about what they wanted. Where a lot of apartment dwellers in the cities, moved out towards the suburbs. They moved further out. They wanted more space and more land. That kind of put that crunch on the real estate market in those areas. And back then, realistically, the people that were in those areas were a little bit higher earners. So, it was the older millennials, it was the Gen Xers that were kind of in that situation who could afford to do that. So now that we're looking at kind of those after effects, more millennials, they're looking at just kind of their opportunity to buy, and it's not there anymore. They were probably in a much better place to buy a few years ago when the pandemic first hit, but it's a very different environment, a very different market, and that opportunity, they might feel like they kind of missed the boat.
Yeah, no, exactly. Because a few years ago, maybe like 2020, 2021, the interest rates were a lot lower than they are now.
Yeah.
So that was the right time to buy. So now obviously interest rates are higher. So it leads me to ask if real estate is still a good long-term investment, do you think?
Well, one of the things that I always challenge people when we're talking about homeownership is, are you going to think about it truly as an investment, or are you thinking about it as a place to live kind of with a built-in savings functionality to it? The reality is when you're renting, you don't build any equity. Doesn't matter, how cheap your rent is, doesn't matter, if it's the best apartment in the world, it's still not going to build any equity. As long as you're buying a home that's not inflated in value, it feel that it's worth your time, your effort, gonna benefit from building wealth through that equity that you are building as you pay off your mortgage, but you also have that place to live. I think the real challenge is nobody knows if they're in a bubble. They don't know when that bubble is going to pop. Many of the people who bought their homes, back in 2008 and right at the time before the Great Recession thought they were buying it at a great time. And then the bubble pops, and then all of a sudden they're underwater in their mortgages. Nobody has a crystal ball. Nobody knows the future. All you can really do is make your best judgment based off of what you know in your current situation. But, if feel expensive, if they feel unaffordable, maybe take a breather, take a pause and say, is this really the right financial decision for me? Because at the end of the day, if it is something that does lose value, then no, it's a terrible investment. But if you're buying it as a place to live and you're confident that you're going to be there for a long time, you're going to do some improvements to it, you could walk out the other side with some nice savings as well as a place that you lived in and have some really great memories of.
Right. Because, sometimes rent can be the same price as a mortgage payment a month.
100%.
So does it make more sense for millennials to stay in their current situation, not just renting, but living with their parents or, other family members or roommates to obtain a higher net worth and work on paying down their other debts?
So, again, the answer here is it depends. And really the
Mhm.
challenge is when you're looking at the millennial group, there's a big difference between the older and the younger
Mm,
millennials. Your older millennial is in their early 40s.
right.
They're probably married. They probably do already have that first home that they bought, before the market was completely crazy. On the flip side, and this is true for anybody who's still early in their career, it's probably better for you to save up a little bit, find ways to save up for that first down payment, save up until maybe the economy and the market's doing a little bit better. But, the thing to keep in mind is, just because you are carrying debt, it's not necessarily a bad thing.
Hmm.
If your rates are reasonable and you can afford those payments, you shouldn't think of that as your major barrier to getting a mortgage, assuming that your financials are otherwise qualify you for it. But, realistically, owning a home before 30 has always been an ambitious goal. And that's even in a favorable economy. Right now, with the tougher market, with the interest rates, with all we've been talking about today, you probably are better off if you are a younger millennial and have that opportunity to get affordable housing. Stick with that, save up for that down payment, work on improving your credit, work on paying off some of that debt, and things will change. We don't know if it will be better or if it will be
Right.
worse. Hopefully it will be better. But once you do get to that point where you're in a better place financially, then yeah, it'll be a great time for you to buy because you'll be in a much more financially stable place. You don't want buying a home to be a gamble.
And not only finances, I think for a lot of people in their 20s, they might not want to purchase a home because of the fact that their life is changing a lot, especially
Yeah,
nowadays. You might not even know where you're going to be from 25 to 30.
that's a great point. I mean, selling a home is a significantly more difficult endeavor
Right.
than ending your
Exactly.
rent, your lease, or it is a process, and it can take a long time, and it can not necessarily go the way you want it to. Yeah, if you're planning to move and be mobile, or anything the next couple of years, probably shouldn't be buying a home.
Yeah, I think that's with anything too, because it's funny. Me and my fiance just leased a car because our life can change so much in 3 years. We don't know a car we're
Yeah.
even going to need in 3 years. We can have kids and everything. So I think with
Yep.
everything is different for everyone at different ages. So with that, do you think there is a right time to purchase a home?
No, it is highly personal for everybody. Because again, not everybody has ambitions of buying a home. Having an apartment and not being responsible for the upkeep can be a huge value add. One of the things that happened to me personally is I moved from a condo to, standalone single family home. And at my condo, the association had to take care of the exterior upkeep and the
Hmm.
snow removal. And that was a fantastic benefit that every time I start up my snowblower, I miss dearly.
Yeah, I was just
So,
thinking about the other day too, because
yes.
I'm in a house too, and I was just talking to someone who was in an apartment, I was like, if it snows, I have to shovel, and they're like, oh, I don't have to shovel in an apartment
Mhm.
or anything. So there are some pros and cons.
And a lot of those, appliances in your
Yeah.
apartments are covered by your
Hmm.
landlord. And let me tell you, I've in the last 6 months, I've had a dishwasher issue, I've had
Hmm.
a hot water heater issue, I've had a furnace issue,
Right.
I've had gutter issues, and all of those are coming out of my pocket.
Right.
And if I was a renter, that's one less thing that I would not
Right.
need to stress
Yeah.
about in my financial life.
Right. And I think, yeah, it's other than the mortgage and all the interest rates and everything, that's something you have to think about too financially
Yep.
down the line when buying a house. So, what advice would you give to millennials who are feeling discouraged by the current interest rates and housing market?
It's completely justified. It's a tough market, it's a tough environment, but don't lose hope.
Hmm.
Things constantly change over time. Nobody knows where the markets will head. If you really had your hopes on buying a home in 2023 or 2024, I'm sorry, maybe remanage your expectations and kind of rework your timeline. Like I said before, the pricing is already starting to move a little bit in the better direction for buyers. The interest rates are starting to move a little bit better in for buyers. So, it's not all doom and gloom. And the reality is too, and you shouldn't necessarily hang your hat on this, but you can always refinance down the line. If you do find that perfect home and you can really just squeak by and afford it, you can always refinance down the line. And you'll probably be in a better financial situation going forward because, again, still early in our careers, the sky's the limit.
Yeah. And I think also, as you mentioned earlier, with the retirement age being people are retiring later and later, you think you are going to be in this house for maybe longer than what you would have 50 years ago. So you can think about that too. So everything takes time. It'll happen when it's meant to happen. And you never know when the market's going to change. So Grant, thank you so much for being on the podcast today. I really appreciate talking to you.
Thanks for having me, Katie. I enjoyed myself. And do you mind if I make a plug for my podcast?
Yeah, of course. Tell everybody, and I'll make sure to leave it in the description of this podcast as well. So go ahead.
All right. I appreciate that. Well, you can learn more about the intersection of your emotions and your finances on the Wellbeing and Your Wallet podcast. And you can find that at affinityfcu.com, as well as any of the major podcasting platforms out there.
Great. So once again, I'll put that in the description of this podcast. And I think one of our lovely Kim Cole, who's been on our podcast a million times, is going to be on yours as well in the future, right?
Yep. We're looking forward to having her.
Yeah, we're excited too. So thank you again, Grant.
All right. Okay. Thank you so much, Katie.
Buying a home may not be on the top of many young millennials' minds. Between student loans, other debts, and not rushing to start a family, many millennials may not feel there's a need to buy a home. The higher interest rates are also pushing many millennials out of the housing market. There's not a right time to purchase a home. The right time will vary from person to person, and there may never be a right time. If you're a millennial currently house hunting, don't lose hope. Take a break from the hunt and regroup. The timing might not be right, but you will become a homeowner one day. With that being said, that wraps up another episode of Millennial Debt Domination. Don't forget to subscribe to the podcast wherever you're listening. And if you're listening on Spotify or Apple Podcasts, please rate and review us there. I'll talk to you next time, millennials, Gen Zers, and everyone else listening. Bye.